give a very brief overview for those that are not intimately familiar with the space as to how solar started in the United States and kind of how it's developed into an industry that lends itself to securitization. The solar industry was created through government support, originally with cash grants from the U.S. government, and then supplanted by investment tax credits that really originally drove the industry. And that will be reflected in some of the securitization deal structures that we talk about. The states also support the solar industry through several methods, including what's called net metering, where the states require utilities to buy excess power generated by a customer's solar system at a very advantageous rate and give the customer a credit against the utility bill. Most customers' systems obviously you generate power during the day. That's for most customers a low usage period. And then in the evening when there's a high usage period for the customers, they don't generate anything from their solar panels. So net metering is very important for the value proposition to the consumer. States also provide their own subsidies in the form of credits for solar renewable energy credits, which also make up part of the financial gain for this area. And then finally, governments have adopted PACE programs, which is an acronym for Property Assessed Clean Energy, which is basically a tax lien structure. There was a panel on this previously in the conference, so I'm sure you all know all about that from that panel. So the development of solar in the U.S. was really through the larger companies that latched onto the investment tax credits. They raised money from tax investors, and the structures they used had to monetize those tax benefits because the solar companies themselves were not tax positive. It's a polite way of saying they lose money on a regular basis. So as a result, that led to a particular structure of so-called third-party ownership, where the developers owned the systems, not the customers. And that allowed the monetization of the tax benefits, but it also led to some structural points that we'll talk about later. The market has recently really changed as solar has expanded, and the big change is that there are companies like Katya's company that have come in and originate loans to allow customers to buy systems directly. And this has also changed the way systems are installed. So you don't need a big installer. The installers will partner with Katya's company or similar financing providers with a platform, and I should let Katya explain that more clearly.
Sure, thank you, Andrew. So Mosaic is a solar loan financing solution provider to installers. Really does just that. We come in at the point of sale as a seamless technology portal-based credit underwriting system that the borrower sees as just as several screens of application, electronic application. Once they are approved for the loan and sign up for the loan with Mosaic, the installer then goes on to install the system and take it through to PTO stages. This allows the borrower to monetize the ITC credit for themselves, which has been a big draw for the borrower's appreciation of the solar loan solution versus lease. Additionally, the borrowers love the fact that solar panels increase the value of their properties because they're assessed as a capital improvement project. But for installers, Mosaic partners with over 125 installers currently that are active on the platform. We do partner with the top names in the space and work with 15 out of the top 25 in the US. For context, there's approximately 5,000 installers, solar installers. A lot of them are smaller mom and pop and regional shops. We do have a handful of those, but we do work with the larger names in the space, including Solar City, which love using our platform for the ease of execution and the capital that we provide to the borrowers or the buyers of solar panels that like the financing solution through the loan, which allows them to close the sale and convert the customers.
So that's really led to sort of two different types of ABS transactions in the solar space. And the first are transactions that relate to the third-party ownership model. And those were the early securitizations, first out of the box, primarily by Solar City. And there are two variants of that structure, one with tax equity and one without tax equity. Kroll has been involved in all of those, and in the ones without tax equity, we'll talk about some of these details when we go through the risks specifically, but it's a much simpler structure. Tax equity adds a level of complication that's made it difficult to execute certain structures in the ABS market, although the two most popular tax equity structures of inverted leases and partnership flips both have done securitizations. I think the brain damage on the partnership flip structure was such that most of the execution now in that market has probably either been done in the private market, not through a 144A securitization. Inverted leases are a little different because of the structure can be simplified and the investors can be protected against risks that relate to the tax equity. That's an asset class that is able to be securitized more easily, but it's a much smaller percentage of the tax equity market, so you just see fewer deals. And then loans, which are the new asset class in solar securitization, and Katya worked on the first one, which closed earlier this year and is really opening up that market. So that's basically a consumer loan product, much simpler without all the bells and whistles and that attend a third-party ownership solar securitization. So just to give you kind of an overview of where the market has been in the last 3.5 years, there have been 10 transactions, and over $1.3 billion have been raised. We put in a list, which I'll flip through without going through in detail, of the 10 deals that have been done. And you can always contact me if you want the copy of the presentation for these details. It creates obviously very advantageous financing for the developers and the originators. So it's going to be a growing asset class for securitization. These are the 10 deals. They started with Solar City first in late 2013, and they reflect starting with no tax equity, then adding tax equity, and then eventually moving to loans. And most recently, the most recent deal that has been done actually has been done by Sunnova, which is a directly owned lease and PPA structure. So the market is really accommodating both types of solar transactions. So we thought we'd spend the balance of the meat of the program discussing the risks, both from the asset class and the customer side. So in terms of the asset class, and looking at this and the system performance, Andrew's been involved in this from the get-go. So what is the view of the rating agencies now in terms of the system reliability, system performance, and most importantly, whether any reserves are necessary to ensure continued operation of the systems?
Sure. So I think what we've seen over time is that solar has performed much better than what was originally expected. When we look at a project or a securitization, what we're really looking at is how many systems do we have in this portfolio? What type of panels are being used? What type of inverters? And what's the ultimate forecast for generation? And this is slightly different than when you're looking at it from a loan perspective, where you're focusing more on the unsecured nature of it, or the credit quality of the borrower. When we're looking at a PPA or a lease product, what we're looking at is the ability for the system to generate electricity, and then what the contract rate is, and the ultimate revenues that are going to come in from that. When we're forecasting generation, we use a P90 or a 90% confidence interval on where we think the generation will be. What we've seen over time is that those systems have performed much better. They've performed closer to a P50. So what we've seen is earlier on, many of the transactions we've rated have seen upgrades. And more recently, at least on the project financing side, we've been comfortable with a lower debt service coverage ratio when looking at it on a P90 perspective, because we're more certain in terms of what the production will look like. So the volatility in the cash flows has been much lower than what we've expected. In terms of reserves, this is early on what you would see is that all transactions had inverter reserves in place. What we started to see over time is that the responsibility for maintaining those inverters have switched to the O&M provider in many cases. So what we would do there is we would look at the credit quality of the O&M provider. If it's sufficient or higher than where we're rating the transaction, it's fine if there wasn't a reserve in place, because that entity is ultimately responsible. If not, we would look to the ability of the project or securitization to generate enough cash to replace those inverters over time. So I think it really depends upon the construct of the transaction, the credit quality of the entity providing the O&M, whether or not a reserve is needed.
So the two key parts of a PV system are the panels and the inverters. So panels, I think it's fair to say the industry has gotten comfortable both on the investor side and the rating agency side that panel life is going to far exceed the life of any contract, even the long-term contracts of 20 years or the longest loan terms for consumer loans, so that panel life is not really an issue. Is that right?
Yes, I think we still have, as you're starting to go out past 25 years, I think while the useful life from the independent engineers is to at least be 30 years, we think there is some uncertainty towards the back end, just because we really haven't seen many systems perform that for that period of time. So what we'll do is we'll increase our operating assumptions. So we might have a higher degradation stress, so the amount of power that the systems lose on an annual basis. We might reduce the availability assumption, given that they're older, they might be offline for a longer period of time to be fixed. But we do think they'll perform over that period of time. We don't have a view that suddenly one day, 25 years comes and then all the systems stop working. That's not going to happen. It's over time. I think they'll just need more maintenance, and they'll have operational issues, which we try to incorporate in our stress.
So solar panels so far have really become commodity products, and if you may remember from the press, whatever U.S. manufacturers there were of solar panels, all were basically had their lunch eaten by the Chinese panel manufacturers. The interesting thing to see in the next few years is that some of the larger solar developers are looking to come out with very specialized products. So SunPower has their own product, which they view as a technologically superior product. SolarCity has announced, well, now Tesla has announced panels that are going to be really, and there are others in this space as well, that really mirror roof shingle style, both Mediterranean style of the curved terracottas and the slate style or glass blocks for more modern construction. So it'll be interesting to see when those start to come in, what the technology issues will be and what the independent engineers' view will be on those going forward. When we first started these deals, inverter life was a big issue and was, I think, even in the short-term deals, was viewed as a probable replacement requirement. Inverter life, I think, from the inspecting engineers, seems to have also extended out as well. Is that right? What's your view now in terms of sort of the useful life? Obviously, it depends on the manufacturer, but
yeah. So I think many of the independent engineers have a longer useful life forecast for the inverters. We're depending upon the inverter type. So for string inverters, we do assume that they're replaced over a 10 to 15-year period. For microinverters, which are inverters that are specific to the panel, there is a much longer useful life. So depending upon that, the technology type will have different stresses. So for string, we are assuming that they're all replaced over years 10 through 12. For microinverters, we'll apply a stress longer out. But the number of times they're replaced will depend upon the tenor of the financing. So for a 20-year financing, we'll assume they're replaced once. If it's a 30-year financing, we're going to assume that they're replaced almost 3 times. So I think that the term of the financing is going to dictate how many cycles we go through on our inverter stresses, and then what cost we are assuming when those inverter replacements occur. Earlier on, we were of the opinion that inverter costs would remain relatively flat, or if not increase, and really what we've seen over time is that those inverter costs, similar to panel prices, have continued to fall as they become much cheaper to manufacture. So that's actually been a positive for the deals that have been rated so far, because the stresses we were applying a couple of years ago were much higher than what's actually occurring in terms of replacement parts and systems.
So for those that aren't intimately familiar with solar, inverters are devices that take DC current produced by the system and convert it into AC current that feeds into the house and to the grid through net metering. In the third-party ownership structure, there's often performance guarantees that are given by the developer, as well as O&M warranties for the systems. So I think a big focus of the rating agencies has been O&M performance for the third-party ownership. Can you explain kind of the rating agency view of how you deal with the risk of O&M and mitigate O&M risk of where usually it's the developer that's providing the O&M performance?
Yes, on the PPA and lease side, it's extremely important that the systems are operating and they're operating to their ultimate capacity framework. And the reason being is if it's not generating electricity, you're not generating revenue. It's slightly different on the loan side. So here, what we're concerned about is that if the system does go offline for a period of time, the revenue forecast that we were looking at is not going to be accurate. So one thing that you want to make sure is that there's an O&M provider in place who's able to monitor the systems, and once there's an issue, that they get there and they're able to correct it and get the systems back online. So in many cases, for PPA, which is a power purchase agreement, the way that the developer is paid and ultimately how the money flows through the securitization is on a percentage, it's a price per kilowatt hour. So whenever you're generating, that's how much money you're going to generate. On a lease side, the company provides a performance guarantee. So if production is lower than a certain amount, the company actually has to make a payment to the homeowner, or what they do is they provide a credit to reduce their monthly payment. What we do is we assume that the developers and the O&M providers are gone day one. So we're providing high to mid investment grade ratings on many of these deals. And our view is many of the developers, the credit quality is not as strong. So what we then assume is that the securitization or the project needs to make those payments. So any performance guarantee payments that we're expecting, we're assuming comes out of the transaction cash flows. Inverter replacements, that would ultimately be the responsibility of the developer. We're assuming the securitization makes it. And the same thing on the O&M fee. So we do need somebody there to maintain these systems. So we increase the O&M rate to an amount that we think is sufficient to attract somebody else to come in and maintain the systems in a distress scenario. More recently, what we've seen backup services or warm backups in deals, so that if there is an issue with the developer, that there's somebody else who could step in and collect the payments. And we've also seen transition managers in place. So these are entities that would go in and find a new O&M provider to replace the current O&M provider in a distress scenario.
If I can jump in here.
Yeah.
I think if members of the audience here are feeling that this is all very technical and complex, you'll be pleased to hear that in the solar loan asset class, you don't need to deal with any of this complexity. Because the customer, as the owner of the panel, is responsible for O&M, which is typically minimal. They're very low maintenance panels, and inverter replacement in, after year 10 or 15, whenever that breaks down, that cost is very manageable. Right now, they cost around $1,500, if I'm correct. The costs continue trending downwards, so that will diminish even further, and is very comparable to perhaps replacing tires on your car a few years down the road. So very manageable expense for the borrower to maintain, and the securitization structure doesn't have to bear those various reserves and stresses that Andrew just described. We're still, I guess the only applicable thing is performance guarantees, which in solar loans are outside of the loan contract and so are not typically an obligation on Mosaic, but Kroll has taken a conservative approach in this case and are assuming that it's something that may affect borrower behavior if the performance guarantor goes away.
So I guess that leads to the discussion of the maintaining the consumer's value proposition. So I think initially in the view of the rating agencies and looking at the market was with third-party developers that the customer should always have a lower rate than they would have just from buying electricity from the utility. In the loan market, I think that's part of the sales interest of the consumers, but I think there's more flexibility as well in terms of the consumer view. So I guess some of your loans are offered with shorter tenors if the customer wants to own sooner, so they're not necessarily upfront saving as much against the utility bill as there would be with a third-party ownership or a longer-term loan. So how do you see the customers responding to that in your market?
Sure, and that's a great that's a great lead-in into the borrower, I guess, or the customer benefits and how do they see loans versus leases. In loans, first of all, they like the ownership model because now that the panels have become a lot cheaper and in the range of $25,000 to $30,000, it's equivalent to a kitchen remodel. So it's not an outrageous expense. It's also you're purchasing technology that has been proven to work and is spreading into the mainstream as adopted technology that is not rocket science anymore. So they're comfortable to own. They like monetizing the ITC because it's a nice 30% discount on the price of the panel. They also like the fact that, as I mentioned earlier, there's an improvement of the real estate appraisal due to the solar panel, and it's easy to transfer ownership as well. I think in a lease structure, if you're selling your home, you need to make sure that the incoming new homeowner takes over the lease liability, and that's a long-term contract that not everybody may want to undertake. Another big consideration is, and we call it the pot of gold at the end of the rainbow, is when you have paid out your loan, and if you pay it off sooner, you reach that point sooner of generating entirely free electricity through your panel. So that is something that really enhances the overall savings that a system provides. On a 20-year loan, it's easy to envision an example of $70,000 of savings over 30 years life of the panel, because you do generate monthly savings versus the electric bill, and you also have free electricity after you've fully paid down the loan.
So Andrew, we had a question? Sure.
Yeah, hi, sorry, I'm way in the back. My name is Angelique Pietersen, Peter Jam. I hear you talk about 20-year periods and the consumer very much involved, but could you explain a bit how it works when, people do move around, change house, houses can be empty, people can just leave, or we've had a crisis when we saw in the crisis that people just left their home if they couldn't afford anymore. Can you share how you've covered that kind of risk? The consumer not living there or changing the house, so does the contract stay with the house? So the new buyer has to agree to take over any obligations that the previous owner had.
Sure. Yeah. I think the answer is different depending upon whether you're talking about the loan model that Mosaic uses or whether you're talking about a third-party ownership, the lease and PPA structure. So I'll let Katya answer on the loan side, that question on the loan side.
Absolutely. And before I get to your question, I'll just answer the last part of your question about shorter tenors, because we do have a portion of consumers who like shorter tenors, 10-year or 15-year, because they like paying lower APRs and they like getting done with their loan payments sooner so that they can realize the free electricity earlier. And for them, it doesn't matter
I
that
guess
their
that
monthly...
makes it easier to
their
sell the
monthly-
house too, because then you
does.
have a smaller loan remaining.
Yes, and their monthly payment may be larger than their previous electric bill, but to them, it's not a consideration that's important. Going back to the, change of ownership, in a typical sale or refinance scenario, most frequently, the Mosaic Solar loan gets paid down. So that's a full prepayment, because the purchase price of the home will cover the cost of the panel. And it's not a requirement for our loans, but this is what happens in most situations. We do have ability to transfer the loan obligation to the new homeowner, assuming that they qualify under our credit criteria. And that happens occasionally, but not very frequently. And you're right to refer to the recent crisis. We do think that default performance for solar loans will be highly correlated with mortgage performance. So if somebody is in a true distressed situation, they have a life event, they're not able to meet their mortgage obligations, they leave the home, this is when they stop paying for electricity, which means they stop paying on the Mosaic Solar loan. But if they're in the home and they're buying food, they need the fridge to work and the electricity to work, and the Mosaic Solar loan is a cheaper option than the electric bill in most cases.
I think that last part that Katya addressed applies also to the lease and PPA model. So I think the same risks are there. I think the rating, I got to let Andrew answer this, but I think it does correlate, in your view, the risks correlate to the mortgage market as well. You use a residential mortgage model for looking at that?
Yeah, I think, the way we look at it under the lease and PPA product is the first thing and the most significant risk that we focused on is the value proposition. So we believe electricity is an essential service, and as long as you could buy electricity from your solar system at a rate that's below the utility rate or the retail rate, that you'll continue to do so. Once that value proposition changes, and now you could suddenly buy electricity from the utility at a rate that's lower than your solar system, we think then there'll be some renegotiations that will take place. So that's one area that we look at. The other is, as you mentioned, pure defaults. So a default where a customer just no longer could either afford the payment for electricity or afford their mortgage payment. So what we do is we take the credit quality of the current pool. So we take the FICO scores of the borrowers and we take their locations and we run it through our mortgage model to come up with a probability of default. We then take that probability of default and we double it. And the reason we do that is exactly what you pointed out, is that every 7 years, at least in the US, a home is sold. So if you're looking over a 20-year period, it's likely that home's going to be sold or change hands 3 times. So there's no limitations or provisions in place that say the homeowner that is assigned the contract has a minimum credit standard of X. So by doubling it, what we're saying is that we think there's going to be credit deterioration over time, and increasing our default probabilities by 2 times, we believe accounts for that potential uncertainty.
So the solar market, I think the 2 things of the solar market that haven't really given enough data to really know what the ultimate outcome would be in a meltdown scenario like the financial crisis are that, first of all, the market really started building after the financial crisis hit. So the worst of in the U.S., so the worst of the financial crisis, I don't think, affected homes that had solar panels. Second part of that is that the credit quality of, so far, of the homeowners that have solar is very high. When you have average weighted FICO scores that are over 700, they're way into the prime territory. And actually, one of the criticisms of solar on individual homes is that it's an upper middle class government subsidy. But from credit quality point of view, that's a good thing. But Andrew, you've looked at historic performance. I mean, historic performance is still about 10 years only for the industry as a whole. And what has been the loss experience that you've seen in reporting?
Yeah, so it's been minimal. I would say for all the deals we rated, it's been 2% or lower. And for the most part, our loss forecasts are probably, and this is pure loss, so this is people that default, and then the recoveries associated with the systems are zero, are probably around 10 to 12%. So the losses have been relatively small and nowhere near what we were originally expecting.
So when you say 10 to 12%, that's not 10 to 12% of the pool.
That is 10 to 12% of the pool in terms of,
Right.
So that's just one side of it. That's the default where the borrower cannot make their mortgage payment. We assume they default, and we assume recoveries with those systems are zero.
Right. And what the developers have been able to show you, although it's a limited historic data, is that the actual loss rate in those situations is much less.
Is
right?
much less, yes.
So typically what will happen is for many homeowners, they don't go through a foreclosure sale. They don't abandon the home. They do what's called a short sale, where they stay in the home and they sell the home for below the mortgage amount. So the lender takes the loss, but it avoids the problem of an empty home and, even further deterioration of the value of the asset from the lender's point of view, which is why the lender is willing to do it. And in that scenario, it also makes it easier to renegotiate the contract if it's a long-term lease or PPA, or the loan if the buyer would be willing to assume the loan. But I think, Katya, from the loan side, have you had any experience at this stage, or is your product still new enough that it really don't have any relevant data at this point?
Mosaic has about 3 years of portfolio history, so it's a fairly young portfolio. We've had a handful of defaults to speak of and even fewer recoveries because the recoveries will take some time to work through. I think it's important to note here that there is no ability to renegotiate on the loan, which is a purchase commitment, and it's not, your P&I payments are what they are. They're P&I. They're not dependent on, electricity generation or your willingness to make them. That's a commitment that you make as a buyer. So we have not had, significant history of modification or defaults to really draw history, but I think it's good to hear from Kroll that the market overall, or you're feeling comfortable or more comfortable with the lease performance, because that has echoes for the loan performance, because given the similarities in solar panels, but the different structure of ownership versus not ownership, there will be the positive credit characteristics will carry over with, I think, a stronger credit positions of loans driving the defaults to less than that.
So on the lease and PPA side, we've talked a little bit about the maintenance of the value proposition for the consumer and the risk and the selective default risk, as opposed to credit overall, like consumer credit defaults. Over the 3.5 years now that you've been looking at these deals, do you think that's your views have changed, or in terms of the selective default risk? Has that been mitigated by experience, or is it still the same?
Our views are still the same. I don't think we've gone through a cycle yet to really stress it. So if you look at the way the contracts are structured, early on they provide about a 20% savings to prevailing retail rates. And then the contracts, some of them have an annual escalator of say 2%. So the way that they can get in trouble is if those contracts are rising at 2% and say utility rates are falling at 2%. At some point it's going to cross. We haven't got to that spot yet. So when we look at it and we're stressing the deals, it's not necessarily what we expect to happen. I think, from a rating agency perspective, most of the stresses that we come up with are extremely conservative and highly unlikely. And the reason that we're doing that is if we're assigning an investment grade rating, we want the rating that we're assigning to be able to perform even under extreme downside scenarios. So we don't think that's going to happen, but we're still stressing the cash flows that way in order to protect from that downside.
I think the developers would agree that the extremely conservative view and the highly unlikely.
Yes.
But it is a new market, that's recognized. So that's really primarily an issue that I think affects the lease and PPA side more. Katya's view is that it doesn't really affect the consumer side. Do you see, from your view, Andrew, that there's sort of still a selective default risk in loans in terms of looking at the consumer's perception of the value of the system, which effectively means the willingness to pay the loan?
I think Katya pointed it out that I think the incentives of the customers are different. So someone that enters into a PPA or lease, they're doing it because they want to reduce their electricity bill. They're never going to own the system. At some point, they'll have the developer take it back, or they'll get a new one put on, and it's like a cell phone, right? You're just going to constantly upgrade over time, and you're going to get the newest product out there. And as long as it's providing you a service that you deem beneficial, you'll continue to use it. Whereas with a solar system where you're entering into a loan to purchase it, you're not necessarily as focused on that payment compared to what it's doing for you, because your ultimate end game is much different. You're looking to own the system, say, in 5 years. So that's all you're focused on, is reducing your loan. Whereas if I'm entering into a lease or a PPA, I want to reduce my electricity rate, so my electricity bill. So I think it's different. So I think the value proposition, I wouldn't focus on it as much on the loan product as I would on the lease or PPA.
Yes, and thank you for that, Andrew. I think it's important to note here that any selective default or selective walking away from the panel that you own and have bothered to put up on your rooftop is dangerous, because you risk losing your credit score and you're ruining your credit history. So is it really worth the trouble for a mid-700 FICO borrower who is a homeowner, who has made this very thoughtful decision to go green and do good for the environment, and to save money in the short term and the long term? Why would they decide to walk away from it and ruin their credit score? So that's a strong disincentive in the solar loan space.
But one different aspect of the solar loan space is that, as Katya mentioned earlier, the consumer is the one that owns the system and therefore is eligible for the investment tax credit for 30% of the system cost. That's a nice savings. And in the loan structure, that is intended to be a prepayment of the loan to allow the customer to lower the customer's monthly payments. There's been a lot of concern from the investor side and the rating agency views of, will customers do that? And what happens if customers, they don't? They're not obligated to in most of the structures, if they just decide to take the money and put it in their pocket. So what has been what you've seen, Andrew, from other deals where that have a similar loan type structure? What's your view now on the issue of loan reamortization and customers sort of pocketing the ITC instead of applying it to prepayment?
Sure. So the first Solar City My Power transaction that we rated was a loan product. It's structured much differently than Mosaic's product, but what it was intended to do was mirror a PPA or lease. So provide a customer with a reduced electricity rate. And the way it worked was you entered into the agreement, and you were going to pay a certain amount. And when you received that investment tax credit, if you then went ahead and prepaid your loan, it would reamortize, and the savings would even be more pronounced. When we looked at it, we assumed that there would be zero prepayments, that none of the customers would use that ITC to prepay their loan. We assumed that they would go out and do something else. What we actually saw was a large portion of them actually did take those proceeds and prepay the loan. I think up to almost 40% of them. So what that did is it resulted in the securitization amortizing down much quicker than what we've expected. And what we ultimately did was upgrade those bonds because of the higher prepayments and the accelerated deleveraging that occurred. So we start to give some credit in terms of prepayments on more recent deals, but it depends upon the rating category. If you're going up to single A, we're going to assume a CPR or a prepayment of almost as low as 6%, which is what you would see just in the normal cost of any type of mortgage transaction where people kind of move on for death or divorce or other extreme life events.
Yes, we get exactly 0 credit on prepayments for the single A, so which is the subject of a lot of ongoing conversations, wink, wink, Rosemary. But it's something that will prove out over time, and we understand it's a new industry, new asset class, and everybody needs to get comfortable and see, years of history to prove that, which I'm sure we'll get there. But it is a strong incentive for the borrowers to prepay, to keep the lower monthly payments as part of our loan product structure. It is arguably perhaps better for some borrowers to pay out the higher interest rate debt if they have that with that money. That's up to them. It's their decision ultimately. But we are seeing solid history on that 30% prepayment in our portfolio so far.
So we're a little time constrained, and we want to save some time for questions.
We could talk about this for hours if
Yeah.
people have time.
I think we've touched on many of the structure risks already. The one thing I guess I would note is that in this particular asset class, risk retention's not been a problem for the issuer, so it doesn't really become a structure issue. That's because the advance rates aren't that high yet, so it's a relatively easy hurdle to meet. And I think, Katya, in your deal, you actually complied with European risk retention as well as U.S. risk retention.
That's right, and we're seeing very strong interest from European investors, just judging from this conference. I've had a number of very good meetings, and there's a lot of interest in, one, U.S. high-quality ABS, 2, green bonds, which we are. We're a certified green bond issuer, and 3, European risk retention compliance. So we check off all of these boxes and certainly hope to see more European participation in our future transactions.
So for those that do have an interest in the tax equity structures, I'd be happy to answer questions later about the risks that are specific associated with those, but that could go on for hours. So let's talk in the last few minutes about what the future of solar securitization looks like. You mentioned before, Katya, that solar is becoming more mainstream, and it's moving beyond the early adopters. But you're still targeting a high FICO score class, right? So it's still a product that's really aimed for the higher end of the consumer credit market.
That's right. The average FICO on our originations is in the mid-700s. So that is certainly, you're right, it's the higher income population, all homeowners. There's a lot of talk and interest in developing solar loan products for the LMI borrower base, low to middle income, which frequently but doesn't have to be correlated with lower FICOs. And so this is something that we're envisioning, not perhaps for the core program, but maybe in partnership with specific banks who are looking to do this solar financing in their areas of footprint.
And I think it's almost another panel question, which is really, is the market going to coalesce around either the third-party ownership, lease and PPA model, or the loan model? Certainly, and it's not, the answer is really only going to be answered over time. I think in part, the developers that use PPAs and leases will continue to sell those because that's what they do. If you started with a blank sheet of paper today, maybe the structures would look a little different. But I think, Katya, I think you've seen tremendous growth in your segment, probably much faster than the traditional lease and PPA developers.
Right. The loan financing solution is clearly overtaking the market share from leases and PPAs. And that's driven both by consumers wanting to own directly and by installers who like getting paid up front, as they are when the customer pays cash or is financing with a loan. In a lease structure, their stream of payments is spread over, over 20 years, which really kills their balance sheets and the equity story if they're a public company. So there's a lot of shift in the industry to prefer loans.
And the last question I wanted to ask, is we are running out of time, is battery storage. So it's sort of the natural for solar, since solar doesn't produce electricity when most homeowners need it. So are you seeing more battery storage as part of the loans that you're doing? Consumers are willing to pay for that as an additional cost?
It's still relatively small, but now that various installers are rolling out batteries as a product, such as Tesla and a couple others, there's a growing interest for that, and I do expect that this will find its niche space, maybe more than niche, in future sales of solar panels that will include battery storage I think over time it will just become a standard part of the package.
Andrew, do you see any difference in the rating agencies' concerns with battery storage as compared to just having a system without battery storage?
Yeah, I don't know. In terms of the battery technology, we would need to work with an independent engineer to determine how long its useful life is and how it will operate under different conditions. I do think as you see changes in net metering that you're going to need batteries in order for solar to be economical in certain states. I think Hawaii is probably one of the best examples where they've changed the net metering laws going forward. So it becomes difficult, at least from a PPA or lease perspective, to continue to compete. But if you have a battery and you could almost completely disconnect yourself from the grid because you're able to kind of produce and then store the excess capacity instead of selling it back, I think it actually makes sense. So I do think batteries are going to be needed for the industry to continue to evolve, at least on the PPA and lease side. It's just, when does everyone become as comfortable with the technology that you could give some credit to it over a long period of time?
So the investment tax credit does come with limitations on how big the system can be. So you can't have little mini generators on your house. So solar is not a 100% replacement at this stage of the game if you're still qualifying for the investment tax credit. So even with battery storage, customers don't necessarily go 100% off the grid, but it really will help them in states that are moving to time of use electricity pricing, and Hawaii is the big example. And so when most homeowners use electricity, they're using it at the highest peak rates. So, the late afternoon, early, people come home, they turn on their air conditioners, they're home, they cook dinner, and so forth. Battery storage will help, those consumers lower their cost as well. So we could go on for a long time, and we'd love to go on for a long time because it's what we do. But we'd like to also give you a chance to ask questions if there are any you'd like to ask. Yep. So, Katya, do you want to take a first stab at the first part of that question?
Something that we're talking about and are very excited about. And this is not a line of business at the moment, but it's in idea stage. And I personally would love to explore emerging markets, perhaps closer to home first, maybe Brazil or Mexico or Panama, and explore Africa for off-grid solutions. I think there are a lot of similarities to micro-lending that we can draw from, and if we can figure out that market, I think that would be a huge game changer for the solar space.
I think, you know, in terms of securitization, I think securitization, you know, is always sort of a second-generation financing. So you have to get somebody else in there first, and you know, banks and non-traditional lenders would be the first stage, I think, of financing. And in Europe, I think, in terms of Europe, I think there's definitely, you know, an opportunity. I think the question is just really the need for the financing and, you know, as a lower source of capital.
I'll be sure to contact you for the warehouse line for that.
Yeah.
Thank you.
I think in terms of Africa and emerging markets, you know, solar securitization is going to be a product that would be, I mean, it's useful, but just as there have been securitizations of micro-lending, it's really going to be almost a government-assisted process at first, although there's some very interesting, you know, models for solar in emerging markets, including Africa. So we've worked on some projects where, you know, with an installation of solar in Africa where you know, you don't obviously have net metering because you don't have, you know, any ability to have utility performance. And the concern, but the interesting thing is you know, in terms of the concern about how do you collect, it's like if anybody's old enough or seen old movies of, you know, what England was like when you would go to, you know, a bed and breakfast or an apartment, people would have to, if they wanted heat or hot water, they'd have to feed the gas meter. They'd put coins in to get the gas meter running. And it's a 21st century version of that in Africa. So if you know, you put the solar panel on a person's house, if they want to use it, they have to pay for the use on their cell phone, and then the system will turn on for whatever they've paid for on the, you know, through their cell phone payment system. So the collection rate is actually, you know, hugely high. It's a very interesting approach to that.
We should chat about this offline because I disagree with the role of governments. It's clear that the African governments have failed their populations in a lot of respects, including electricity and solar. I think off-grid solar will be driven by private companies and investors and private enterprises. That's, you know, I'm guessing here, but I don't think the government will be super helpful in that enterprise.
Okay. Thank you all for being here and staying to the end. So.
Thank you.